All right. I hope this try works. Zoom is having some technical issues. So, welcome. This is my presentation final project for macroeconomics on currency and exchange rates by me, Odin Avery. All right. So, starting with currency and exchange rates applied, we're going to be looking at a couple of things that focus on today and how it affects us and how it affects the global markets and foreign trade. Currency exchange rates can be explained as two nations' currencies in constant flux, determined by a nation's inflation debt, interest rates, political stability, and trading agreements. Value between the two currencies can be described as how many units of one currency is needed to buy a unit of the other currency. Essentially, in terms of us, who uses exchange rates, you can look at larger affected population of travelers and the tourism industry. In this sense, what affects them most is how much power their currency holds compared to that of a foreign country. The stronger the currency, the less has to be spent. In terms of domestic and foreign trade, the U.S. has found international currency rate as a major issue in maximizing the key $5.6 trillion that is pumped in the country through various goods and services. Over on the right side, you can just see a couple of the major things we're going to be looking up that affect exchange rates. Starting with inflation, of course, interest rates, debts, terms of trade, account deficit. Next, we're going to be delving into the different types of exchange rates. Usually, we look at two different types of exchange rates we see most commonly, and the second one delves almost right into the third one. So the first rate to look at is called a floating rate. Floating rates are separate from fixed in the way that the rate itself is affected by market supply and market demand. A floating rate is often given the nickname self-correcting since it has a way of fixing any issues regarding unemployment, domestic product, and inflation. In rare cases of instability, the central bank will make necessary changes to restore balance in smaller things like unemployment, wages, labor, all those types of things. Rarely, though. Usually it is self-correcting. Next, we'll be looking at fixed or peg exchange rates, which is over on the right side. You can see the U.S. dollar, euro. It's mainly the most strong currencies around the world that hold up the best against others. So, a fixed peg rate relates to matching a price to another major world currency, such as the dollar or the euro. Matching a fixed rate to a stable currency is key to controlling various inflation issues and helps to limit price fluctuations on imports and exports. In some circumstances, even the fixed rate must be boosted by central bank buying its own currency on the foreign exchange market. In the chance of local currency fluctuations, the central bank must be able to match that exchange rate in foreign reserves. So this is just a little bit of a graph and concept analyzation when looking at floating exchange rates and fixed exchange rates. So at the top, you're going to be looking at the floating exchange rate, and you see depreciation of the currency increasing, and it leads to a higher demand for output of domestic products made within the country. So depreciation of currency in a floating exchange rate system can lead to lower prices to export domestic products related to other system currency rates. Give businesses with high volume of foreign export a massive benefit from the strength of other currencies compared to local. Overall, higher aggregate demand and raise GDP. When we're looking at the lower one here, we have fixed exchange rate, which is matched up against other currencies. And with increased levels of depreciation, the dollar can lower first response output connected to the fall in aggregate demand. Reduced consumer purchasing power against other currencies also drops demand. Increased interest rates will also have companies and businesses spend less on investment and borrowing lower aggregate demand. All right, so here we're going to be moving into the determinants of exchange rates and how we apply them to today. For all types of exchange rates, certain macroeconomic concepts control each of them in a certain way. Beginning with interest rates, a major deciding factor in fixed exchange rate systems such as the U.S. causes other economies' currencies to weaken because of the value of foreign investment. Closely related to interest rates, inflation highly impacts currency exchange rates by focusing on certain stronger economies and raising the Fed funds rate to buttress the dollar to other currencies. A booming domestic economy allows for stronger currency against other closely related foreign currencies, also keeping aggregate demand by strengthening local currencies. So here we're going to delve deeper into interest rates and how they affect currency exchange rates on a macroeconomic level. When looking deeper into interest rates around the world, it's clear the US dollar has been beating its competition for close to 20 years. Despite occasional challenges, the US dollar remains strong and plays a central role in the global economy. Its value has increased, with the US dollar index rising more than 5% since July and remaining over 40% higher than 2011. The strength of the US dollar affects economies all around the world as the quote unquote central banker to the world. The Federal Reserve's actions echo across the foreign exchange markets, impacting numerous currencies and countries. The strong dollar is a problem for multinational corporations, affecting their foreign revenues and product prices. Although some companies suffer in revenue, others have learned to protect themselves from the strength of the dollar. Overall income sources and company strategies are more important than changes in the value of the dollar. And then up here, we can see on a domestic level how interest rates affect mortgages, which will affect consumer spending, consumer investment, and debt borrowing. So moving on to inflation, the stronger dollar has caused other currencies, particularly those of major economies like Japan, China, India, and Britain, to weaken. This has created challenges for these countries, affecting their stability to stabilize their economies and contribute to domestic inflation. The fast increases in interest rates by the Fed cause questions about how connected the world financial system is. Weaker currencies make it more expensive to import products, which fuels domestic inflation. They also provide difficulties for international borrowers whose debt is denominated in US dollars. The circumstance also makes a worldwide economic crisis more likely. Central banks and bond markets are also largely affected by inflation and the Fed's high rates. A number of nations, especially to South Korea, China, Japan, and India, have adopted policies to stabilize their economies and support the value of their currencies against the US because it is so strong. Countries have intervened in currency markets and sold off their holdings of US dollars. The possibility of countries selling more US treasuries to maintain their currencies might pose problems for the US government bond market, making it difficult for buyers and reduce the demand for debt. So finally, when we're looking at determinants, we're going to be looking at domestic economy performance. Actually, well, we have one more after this. U.S. importers and travelers among the winners in a strong dollar environment. Importers benefit from reduced costs for overseas purchases, particularly from countries like China, since the U.S. dollar just appreciates so much higher than the Chinese yuan. U.S. travelers experience increased purchasing power abroad as the dollar's strength makes foreign currencies relatively weaker, providing better details on expenses like hotel stays and meals. Multinational companies based in the United States are facing challenges as the strong dollar negatively impacts their profitability. The rising dollar is dealing with two simultaneously hits to emerging economies. These being first, the cost of goods from these economies rises because most are priced in dollars, like oil, wheat, and soybeans. Second, as interest rates rise and borrowing becomes more expensive, nations with debt denominated in dollars are put under increasing pressure. A strong dollar also hurts a lot of American exporters by raising the cost of American goods and decreasing their ability to compete on foreign markets. Finally, looking at the last determinant of currency and exchange rates, we're looking at market forces and speculation, basically everything that affects the world in any type of business way in a micro or macroeconomic issue. So market forces heavily influence currency exchange rates through the principles of supply and demand. If demand for a currency exceeds its supply, its value tends to rise, vice versa. Economic indicators such as GDP growth, employment data, and trade balances influence market powers. Strong economic performance often leads to a stronger currency, reflecting confidence in the country's economic prospects. Of course, political stability plays a crucial role in currency exchange rates. Currencies of politically stable countries are often viewed as safer investments for foreign direct investment, attracting foreign capital and strengthening currency. Conversely, political uncertainty can lead to depreciation. In today's world, an example of a weaker political economy in the sense of allowing foreign exports, investment, is North Korea, being a totalitarian state. Finally, currency values are influenced by the expectations and perceptions of traders and investors. Exchange rates may fluctuate quickly due to speculative trading, which is fueled by variables such as the geopolitical events and economic expectations. So, in closing, currency exchange rates are and have been a crucial impact on humans' everyday life, from domestic product to foreign investment and the value of your own local currency. Investing in one's own economy is always valuable, as strengthening currency will allow you to do the most with your money. In a world where the dollar controls many other economies, being in a smaller currency area can cause many microeconomic issues that are only realized by one affected in a fixed rate system. Thank you very much, and that is my presentation.